You've probably heard a lot about the mortgage renewal wall, Canadians renewing into higher interest rates. But there's a much more dangerous issue underneath that almost no one is talking about. Today's video is about negative home equity. I'm Becky Perro, an independent mortgage broker since 2004. A large portion of the people renewing in 2026 and 2027 didn't just take out mortgages, they bought their homes in 2021 and 2022 when prices were at or near their peak. So the real question isn't just what rate will you renew at, it's this. What happens at renewal if your home is worth less than what you paid for it? That's called negative equity. And while it sounds scary, it doesn't affect everyone the same way. In fact, there's a very specific group of homeowners where the value of their home barely matters at renewal. And I'll explain exactly who that is later in the video. Let's start with what people mean when they say the 2026 renewal wall. Over half of all Canadians are coming up for renewal in 2026. Why is that? Because during the pandemic years, specifically 2020 to 2022, borrowers took fixed mortgages at historically low interest rates. Fast forward to today, and those same borrowers are now staring down renewal rates that are significantly higher than what they started with. That's the part everyone's talking about. What's often missing from the conversation is who these borrowers are and when they actually bought their homes. A huge percentage of these upcoming renewals belong to people who purchased in 2021 and 2022. Those years matter because home prices were so elevated. Competition was intense, many buyers stretched to get into the market, and down payments were often minimal. Since then, in many markets, values have softened or declined. Not crashed, but declined enough that some homeowners are now in a position where their mortgage balance is close to or higher than what their home is worth today. This doesn't mean they've done anything wrong. It simply means they bought at a peak and time hasn't yet had a chance to work in their favor. That brings us to the phrase that makes people panic. Let's talk about negative equity without the fear. Negative equity simply means you owe more on your mortgage than your home would sell for today. It does not mean you are in trouble immediately or you have to sell or the bank is coming after you. In fact, negative equity usually only matters in two situations. If you want to sell or if you want to refinance or switch lenders. This is where renewal gets confusing because renewal is not the same thing as refinancing. At renewal, lenders will look at your remaining mortgage balance, payment history, income stability, and sometimes the value of your home. If you have strong equity, you have flexibility. If you have limited or negative equity, your options narrow, especially if you're trying to increase your mortgage, add a line of credit, or move to a new lender. This is where many homeowners might start hearing, You may have to stay where you are." This brings us to the group I mentioned earlier. If you purchased your home with less than 20% down, you likely have an insured mortgage. That means your mortgage is backed by one of the three mortgage insurers in Canada: CMHC, Sagan, or Canada Guarantee. Here's the key point most people don't know. If your mortgage is insured and you are doing a straight renewal, the value of your home does not matter. Let me repeat that. If you bought with less than 20% down, still have active mortgage insurance, are not increasing your mortgage, and are simply renewing or transferring your mortgage, then you can transfer that mortgage to a new lender, even if your home is worth less today than when you purchased. No new appraisal required in many cases, no equity test, no panic. This group is actually more protected than many people realize. The homeowners who need most proactive planning are anyone who bought with 20% or more down payment, who refinanced after their purchase, needs access to equity, or may need to switch lenders for qualification reasons. For these homeowners, value does matter and planning early is critical. This is why waiting until your renewal letter shows up is often too late. If your mortgage renews in 2026 or 2027, here's what I recommend. Review your mortgage 12 to 18 months early if possible. Understand whether your mortgage is insured or uninsured. Avoid refinancing without proper advice. Don't assume the headlines apply to your exact situation. And most importantly, don't panic. Plan. If you're unsure which category you fall into, that's normal. And that's exactly why this conversation matters. Every mortgage is different. And in 2026 and 2027, strategy will matter. If this was helpful, like the video and subscribe. Share it with someone who bought in 2021 or 2022. And if your renewal is coming up, get informed early. It makes all the difference.